Hello, everyone. I'm Jerry Jones, joined by JJ O'Hare from the O'Hare Wealth Management Team. We are here for our weekly update for the week of April 22nd. Thank you for joining us. Every week we come to you for 15 minutes answering questions of a financial nature that are posed to us by our clients and/or prospects. If you have a question you would like to submit for us to consider on a future call, please do so and submit it at service@o'harewealth.com, or you can text or call us at 414 644 0060. We have a lot to unpack in a very short period of time. If you find yourself struggling to see any of the charts, please let us know and we could send those in a larger format and answer any questions that you might have at that time. With that, we're going to dive right into it with our first and only question for the week. That's for JJ. What is the history of 50% drops in the market, and what is the potential possibility of that happening again? There's a lot there, and that's why we're going to spend a little more time on it this week, folks.
Yeah, hopefully not as long as we spent last week, which was our quarterly chart part. We spent 25 minutes or so explaining a whole bunch of different concepts. If you have any deeper questions, check that video first. That might be a good first resource. But this is the big follow-up. What was the history of 50% drops in the market, and what's the possibility of happening again? Well, in the last 2 years, there's been no 50% drops. But you look at the past 25 years, there's been two of them. You look at the past 50 years, right, going back to 1975, there's been three. But then even if you get to 60 years, you start to get a few more. So what's the history of 50% markets? They're actually relatively rare, and they usually take a long time to develop. It's usually something that happens over the course of several years. What's the possibility of happening again? Well, part of that caveat is how long do you have? And I do this often when we talk about people's futures. We try to plan what might happen, and I look back 30, 40 years, and I have to give people the bad news that this is probably not the last bear market they've lived through. And we're not quite at a bear market yet because the market hasn't fallen 20%. But you're probably going to live through another bear market in your life if you plan to live for the next 50 years or beyond. Is there going to be a 50% decline in the market in the next 50 years? The probability that's probably relatively high, despite the fact that we'd like it not to be. It's out there. It's something we have to account for. All right? Whenever we're doing asset allocation, it's part of what we're thinking about. But what's the possibility, I guess, really in the next few months? Because that's, I think, the real question is what's going to happen next? Well, let's look back at a history of a lot of these pullbacks. This chart goes back to 1871. Yeah, quite a while. Had there been some big pullbacks? Yes. I mean, the Great Depression was obviously a huge pullback. In the 1970s, you sort of churned water and the market went sideways. Famously, I think it was 1968 to 1981, the Dow went from 1,000 to 1,000, didn't grow. So 11 years of sideways. The lost decade, 2000, 2012. The lost decade, we call it. It took 13 years essentially to recover from that initial 50% decline. But those were multi-year declines. It took a long time, and there was a big problem that needed to be solved over a long period of time, right? And let's look at the tech bubble first. What was the tech bubble? We really overpriced a lot of things. We had a very small recession relative to previous recessions. In 2000, we had a 0.1% recession, and it took 6 months, and then it was over. But it caused us to unwind and reprice everything from a stock market perspective. And a lot of companies that weren't making money suddenly had to account for that. That was a huge pullback. It took many years for that to correct. You also, on top of that, by the way, had 9/11. You had other wars starting. You had other problems as well. But for the most part, it was a major overpricing of assets. 2008 2009. What was the problem there? With the global financial crisis. Remember, we were never going to be banking again. Banks were going to disappear from the face of the planet. Well, that was a very, very wild time. We didn't know what the outcomes were. We didn't know what the total economic damage was going to be. And people were losing their homes left and right. That was a very, very nasty period. But you look back at this, it was one big problem that took several years to solve. That was a secular bear market. Right? We had the same problem in the 1970s. But in the 1980s, 1990s, that was a secular bull market. You had a lot of small problems. Right? But it kept continuing. Right now, we still believe we're in a secular bull market. We have a lot of small problems. And if you look right now, this chart goes through April 11th, just a few weeks ago. And you can see the downturn at almost the extreme. In the very, very upper right-hand corner, it almost looks minute and non-existent. Secular bull markets are defined by 10, 20-year up periods where the market seems to keep going up. And you have a lot of problems, but they tend to get solved relatively quickly over that period of time. We still think we're in a secular bull market. Obviously, we're always on the lookout for the switch to a secular bear market. That's something that we're trying to be focused on. But we don't want to confuse the two and say, well, this must mean a 50% decline. We're always looking forward. And, with this is a problem, the tariff issue. This is mostly a self-inflicted wound. And I think most people didn't know what this was going to look like. And that brings us back to a chart I know we've used a couple of times, but I'm going to talk about it a little bit different light this time with a follow-up. This is a chart of economic policy uncertainty, right? When are we most uncertain? Well, we were most uncertain during the great financial crisis. We were very uncertain during the European financial crisis. We were very uncertain during COVID, and we're very uncertain today. What's the good news is usually certainty comes after you kind of see the worst case scenario. And when we talked to experts just a month ago, they all told us the worst case scenario is to see 10% global tariffs on all U.S. imports. That's now the pause during this 90-day baseline. Nobody expected the tariffs to be nearly as high or as far-reaching as that actually came out during what was called Liberation Day. That was a major surprise. Surprise is not good for the market. And by the way, when you watch a scary movie, the first time you watch it, it's incredibly scary. But guess what? All scary movies have a few things in common. They usually have some sort of deadly threat and a few jump scares. Doesn't mean the new movie that's coming out isn't scary, right? But after you've seen it a few times, it's not as scary. And that's what's probably going to happen here in a few weeks. What's the likelihood of tariffs being somehow even higher than they were announced that they could have been just a few weeks ago? Famously, Vietnam is a 90% import tariff. What's the likelihood that it's going to be 180%? My answer is probably not very high. What's the answer? It's going to be 90% or lower. My answer is almost for certain. It seems like that's where we're going, is as we get deals structured and as we get less surprises. Plus, we're not going to be nearly as surprised because we know kind of what the worst case scenario looks like. So we're actually getting more policy certainty. But what happens when you get these big spikes? Well, luckily Goldman did some of that research for us. S&P 500 returns a year after a spike in policy uncertainty index. 2001, you're unwrapping the tech bubble. Yeah, that next year didn't look so good. September of 08, yeah, we were unwrapping the great financial crisis. The next year didn't look so good. 11, just starting there, you had the European financial crisis. You look at all those together, though, as the spikes in uncertainty, really over the past 30 some odd years. This goes back, almost 40 years. Most of the time, you're positive from there because when you go from policy uncertainty to certainty, no matter how good or bad that certainty is, now that you have it, the market has the ability to adapt and move forward. So yeah, what happened in March of 20? We finally got certainty around what we were going to do around COVID. February of 09, we finally got certainty around what we were going to do around the great financial crisis, and you had a very, very positive follow-up from that. So do I think we're going to go down 50%? I can never say never in this business. That's not allowed. It seems unlikely that this would be the cause because it would have to be a tariff spiral that'll take probably several years to keep unwinding. And it'll keep getting worse and worse and worse. We don't see that as being on the forefront. I mean, and we've had a lot of issues lately. I mean, COVID was pretty bad. We have obviously had a really nasty issue with the Ukraine invasion back in 22, and then rapidly rising interest rates. We've had some pretty rough goes here in just the past 5 years. I guess the question is today, consumer sentiment is near an all-time low. We think today is worse than any time since basically the 1970s. If we believe that, it's always easy to believe, well, then the shoe has to drop around the corner. But as I've talked about before, when you look at that chart, I talked about it during our chart party, during those periods, that's usually the best time to invest because that's when you have maximum policy uncertainty and you start to get certainty around things. And as bad as things are, that's usually about as bad as they're going to get. They don't continue to keep getting worse. They tend to turn around, people make adaptations, and things get better. So we're actually on a positive outlook going forward from here. Despite the turmoil that's going on, a lot of it actually is relatively isolated. And this goes back through the end of last week. But most of the damage was actually felt by the Magnificent Seven, and very little of it was actually felt by the other 493 stocks. So part of what we said during our market outlook back in January was that was probably going to have to happen, or the market was going to go sideways for a while as the rest of the market caught up because the Magnificent Seven were leading so far ahead. So if this is the case, yeah, it's a lot of what we're saying was going to happen has come to fruition. And now the question is with sort of this uncertainty shaking out, and obviously people are very scared. This is the first time you've watched this tariff movie in a long time. There's nobody who even really remembers the last time we had tariffs like this in place. Even going back and talking to people who were executives or leading companies in the 70s, had very minimal tariffs. In the 80s, they basically all got removed. But to have tariffs at this level, people have not dealt with it in a long time. And so it's a very scary movie. It's the first time anybody around gets to see it. So hopefully that helps answer the question.
I think it does. And as always, folks, if you're unclear on something, please reach out to us. We'd be glad to go a little deeper on any subject that comes up on these calls. We'd love to hear from you. With that, we're going to talk about our book recommendation, Good Energy. Our entire team is on a journey to being much more healthy. We have our little dips in the road every now and then, like egg rolls. It's one of our weaknesses.
I thought you were going to say like the market has dips in the road.
I like that better. But this book really does a great job of talking about good energy and how to get that positive attitude toward and better outlook on life, especially from a health and wellness standpoint. So I'd highly recommend it. It's one of my favorite books already, and I've read it twice now. So I think it's worth a good pickup time and read it at your leisure and let us know what you think. We always love to hear feedback on these book recommendations. We've gotten it from a few people, so please don't be shy about reaching out and saying, "Hey, didn't really resonate with me," or "Hey, this was really a good read. Thanks for recommending it." Whatever that is, we'd love to hear your feedback. With that, we're going to wrap it up for this week. We really appreciate your time. We hope you had a great Easter holiday. We love being with you, and don't forget to recommend us to your friends and relatives if you have the opportunity to do so. In the meantime, on behalf of JJ and myself and the rest of the O'Hare Wealth Management team, thank you and have a good day.
Thanks, everybody.